Everyone thinks interest rates are set by one person in one room. That is wrong. There are two interest rates. One is set by a committee. The other is set by the fear and greed of millions of investors. And the Fed cannot touch the second one directly. Confusing them costs you money. Let's start with the most basic question. What is an interest rate? An interest rate is the price of renting money. Just like you pay rent to use an apartment for a period of time and then give it back, when you borrow money, you pay for using it. That price, expressed as an annual percentage, is the interest rate. From the other side, if you lend money, the interest rate is what you receive in exchange for giving it up temporarily. It is the compensation for not having that money available now and for taking the risk that it may not come back. There are two reasons why the price of borrowed money is higher than the price of money returned today. The first is time. Giving up money now and getting it back in the future has a cost, because the future is uncertain. The second is risk. The more likely it is that you will not get your money back, the more you demand in return. Those two factors, time and risk, explain why longer-term rates are usually higher than short-term rates. Usually, but not always. And that is the key to everything we will see today. Nothing more. No mystery. An interest rate is a price, like any other price in the economy. The difference is that this particular price affects everything. Your mortgage cost, your bond fund's return, the value of the equities in your portfolio, and the funding decisions of every company that needs capital. The problem is that when the press says the Fed raised rates, and when your bank tells you the 10-year Treasury yield rose, they are talking about two completely different things. Two markets, two mechanisms, and sometimes two opposite directions. There are exactly two interest rates that matter. The first is set by a committee. The second is discovered by the market. The first is the short-term rate, and it is decreed by the Fed. The Federal Reserve, the Fed, has one primary instrument, the short-term reference rate, the rate at which commercial banks lend money to each other overnight or for a very small number of days. A committee meets a fixed number of times per year. The members analyze economic data, inflation, employment, growth. They debate, they vote, and the number changes or does not change based on that vote. That is all. There is no auction. There is no negotiation with the market at the moment of the decision. The committee makes a call and the number is published. Think of it as a dial, a single control in the hands of a small group of people that can be turned up or down according to their objectives, controlling inflation, stimulating growth, or both at once. When the Fed turns that dial up, it makes short-term money more expensive for all banks. Banks in turn pass that cost on to variable rate mortgages, consumer loans, and credit lines. That is what you feel in your everyday life when rates go up. When the Fed turns the dial down, it makes short-term money cheaper. It stimulates credit. It makes it easier for businesses and households to borrow. In theory, it encourages economic activity. That dial only controls the short end of the curve. 1 day, 1 week, 3 months. No further. The second interest rate is not decided by any committee. It is discovered by the market. We are talking about the yield on long-term government debt, the 10-year Treasury, the benchmark used as a reference point across most of the world. Imagine the Treasury needs to finance itself. It issues bonds, 10-year IOUs that promise to pay back the money with a fixed interest rate. Those bonds enter the market, and from that point on, millions of investors buy and sell them every single day. Pension funds, foreign central banks, insurance companies, mutual funds, individual speculators. Every time a bond changes hands at a price, that price implies a yield. If the bond is worth more, the yield goes down. If the bond is worth less, the yield goes up. It is a fixed mathematical relationship. Price and yield always move in opposite directions, like two ends of a seesaw. Think of it this way. A bond promises to pay a fixed amount at the end. If you pay more for that bond today, the return you will earn on what you paid is lower. If you pay less today, the return is higher. The coupon does not change. What changes is the price, and that moves the yield. Nobody votes that number. No committee decides it. It emerges from millions of simultaneous transactions, from the expectations of each investor about future inflation, about economic growth, about what the Fed will do over the next few years, and about what they demand in exchange for locking up their money for a decade, not one night. The long-term rate is a collective opinion, updated second by second, about what money will be worth in the future. And that opinion does not have to agree with what the Fed wants. In fact, sometimes it actively pushes back. Now comes the part that surprises most people. The Fed controls the short end. What happens to the long end? The Fed can influence the long-term rate, but it cannot set it directly. And that distinction changes everything. How does it influence it? Through expectations. If the Fed raises the short-term rate today, investors in the bond market begin anticipating what will happen tomorrow, in 6 months, in 2 years. If they expect those high rates to slow the economy down and force the Fed to cut later, they buy long-term bonds now before their price rises. That demand pushes up the price of the long bond, and therefore drives its yield down. The Fed can also communicate its intentions. It can say it intends to keep rates high for an extended period, trying to anchor long-term expectations. It can buy bonds directly through quantitative easing programs. But none of those tools is direct control. They are levers of influence over a market that, in the end, has its own logic. Result: the Fed raises the short-term rate, and the long-term rate falls. This is possible. It has happened in documented historical cycles, and it is exactly what creates an inverted yield curve, the short-term yield above the long-term yield. Not because anyone decided it should be that way, but because the market and the committee have different views about the future. Here is the image I want you to keep. There are two hands on the curve. The left hand, the Fed, grips the short end firmly and moves it at will. The long end floats in the air, held up by the swarm of millions of investors trading every second. The Fed can pull the thread, can shout its intentions, can buy bonds directly to push the long end around. But in the end, the market decides. Later in this series, we will see what happens when these two forces pull in opposite directions, why it happens, and what it has historically told us about the economy. Why does this matter for you? Confusing the two rates has concrete consequences. Here are 3. First, if you are waiting for the Fed to cut its short-term rate so that fixed-rate mortgage rates fall, you might wait too long, or in the wrong direction. The Fed cuts the overnight rate. Fixed-rate mortgages and long-term loans follow the 10-year, 15-year, or 20-year Treasury yield. That yield is set by the market, not the committee. It can fall before, after, or in the opposite direction. Second, if you invest in a long-term bond fund believing that rates are going to fall because the Fed has announced cuts, you might be surprised. If the market interprets those cuts as a signal that inflation will persist or that the economy will stay strong, it may demand a higher yield on long bonds. Bond prices fall. Your fund loses value, even as the Fed is cutting its reference rate. Third, and most important, the long-term rate carries information the Fed cannot manufacture. It reflects what millions of investors believe about the future of the economy. When the two rates diverge sharply, when the short rate rises and the long rate does not follow, or even falls, the market is sending a signal. That signal is worth understanding before you make financial decisions, not after. 2 interest rates, 2 forces. The Fed controls one directly. The other is discovered by the market every second, and sometimes they move in opposite directions. In this series, we will explore what drives each one, what it means when they diverge, and what that divergence has historically anticipated about the economy. Because understanding the structure of interest rates is one of the most powerful tools you can have for reading what is happening around you. This is educational content, not a buy or sell recommendation. If this clarified things, subscribe to the My Best Wealth channel. We analyze, you decide.